Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the share disclaimer. Be aware neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. As always, this show is for the display of Market Chameleon tools and products. With that, D, you ready to go?
Yep. Good morning, everyone. And I am going to share my screen here. While I'm doing that, quick note to anyone joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it, and he will let me know when questions come in. To give you a couple minutes to put those questions in, we're going to start out looking at our pre-market report to see what type of insights we could get in the pre-market trading activity, and then we'll move on to our questions. Okay, so up here, I'm on our pre-market report, and you'll see this calendar view that allows you to go back dates and see what happened in the pre-market hours on those historical dates. And this allows you to quickly eyeball and compare today's activity or the most recent to the history to see if you could eyeball anything unusual or trend. Let's review today's activity, September 23rd. And here we see we have 553 stocks trading higher in the pre-market, 258 stocks trading lower. We have 292 million shares trading on up volume, 46 million on down volume, and we have $3.1 billion worth of stock trading higher, $727 million worth of stock trading lower. So from that perspective, it seems that the trading in the pre-market hours so far has a bullish bias. Let's look at it from a couple more perspectives, and then we'll move on to our questions. And to do that, I'm going to slide down the page, and you scroll down, you get more information, and now we see this more granular view of what's going on in pre-market hours. We see stock symbols with price and price changes and volume. We also see our most active stocks, our biggest percentage gainers and biggest percentage decliners. And looking at the count, we have 82 stocks that made it onto our biggest percentage gainers list, 39 on our largest decliners. So that also indicates a more bullish lean in the pre-market trading. And when we look at the pre-market trading, the stocks can trade with very low volume and very low liquidity. So we do set trading thresholds to make it onto this list. If it meets those thresholds and makes it onto this list, it could include any security, even low cap stocks. It could be an ETF, it could be a preferred stock, closed-end fund, really any security that's listed on a major US exchange and it's trading in the pre-market hours. So to narrow down this list further, we could use the filters that we have available above. There are two filters here I'm going to discuss that helps you filter out the group of stocks you're analyzing, and you'll find them in different parts of the website where you have these reports, these types of reports. One is in my watch list, and this allows you to screen out or filter out this report by stocks that you saved in your own unique watch list. If you track 10 stocks and you put them, classify them or categorize them and give it a name in a watch list, well, you could then use that saved watch list and filter out this report by those, that criteria, those 10, if any of those 10 stocks make it onto this list. We're going to use, in our example, this an ETF filter because it's a similar concept, but this one already provides you with, uh, by default, certain ETFs to choose from. And I'll show you as an example how it works. When you click on it, you get these different ETFs. And you'll notice that these ETFs are either tracking the market, like a broad-based market, such as S&P, Dow Jones, NASDAQ, or certain sectors. We're going to go ahead and choose SPY, which is the S&P 500 ETF. So let's click on that. And what will happen is, that the list below got filtered by stocks that are holdings in that ETF. SPY is the S&P 500 ETF. So now we narrowed down the group of stocks we're analyzing to S&P 500 companies. And here we see that 8 stocks made it onto our biggest percentage gainers list, 4 on our biggest decliners. And that also indicates a slightly more bullish bias in that pre-market trading activity. So what we did give it a couple minutes, and I think I'll take questions now if you have.
Nothing's popped up, D, but we did well, we do actually, Robert. Do we have a filter, an MC filter that shows what stocks and options benefit from lower interest rates or higher rates? I know they're talking about the Fed, maybe in the chat, they're talking about the Fed maybe making more rate cuts. Is there a way to analyze stocks against interest rate moves, or?
I mean, it's a good question. When we talk about interest, sensitivity to interest rates.
Before you get started, I'm sorry to do this. Could I share my screen real quick before you start
Yeah.
talking about the sensitivity of interest rates and stocks? All right, one more share of the disclaimer. All right, you can take over, D. Thank you.
Yeah. So let me just share my screen. And it was a good question. Well, the Fed right now is lowering interest rates. So we had the Fed meeting recently. They lowered interest rates, and which stocks or options benefit from lower interest rates, or how sensitive they are. And all financial models that I know of, for any risk asset has a component for interest rates, right? The risk-free rate. Almost any model, and every, if you have an option pricing model, there's a component for interest rates in there, right? The risk-free rate. There's a component that you could enter in interest rates in there. And if you're trying to create a financial model, trying to put out maybe a price. How do I price a stock, or how do I price a preferred or bond or whatever? There's always a component there for interest rate. So even across the board, when you're looking at it, you could look at it, well, across the board, if you lower interest rates, right? If you lower the risk-free rate, well, it'll impact almost the entire market, really, because they're all have sensitivities to lower interest rates, and you're competing for returns, right, with the risk-free rate. So as far as a group of stocks that are just impacted by lower interest rates, I would say the whole market, everything is really impacted. And the sensitivity of any one asset, you'd have to run a financial model and test it out. And it's also based on assumptions that you're putting in. Financial models, almost all financial models, they have assumptions in them. You have to put certain, estimates, assumptions, even the options pricing model. So even if we take up options pricing model, I don't know, let's just, I don't know, pick SPY. And when you look at an option, or I'm not going to go into stock valuations because stock valuations are much there's no what so with options pricing models, one thing that we do have is this Black-Scholes options pricing, binomial options for some people use trinomial, and it's a it's a pricing model that you could kind of start out using it across the board, right? Because you have these implied volatility assumptions, interest rates. So the benefit of an options pricing model is like you kind of have this model where you could just apply it, across the board. It's not a perfect model. It's not like this perfect model that gives you exact stuff, but it's a model that we could say, okay, we could apply it to options across the board and start making comparisons. Okay, and then you could start tweaking that model. And that's what usually happens is once you start out with the basic model, you start tweaking the assumptions in there and so forth. With pricing, it's things like, equities and ETFs, and then you're getting into very almost customized models because each stock is kind of has its own nuances and its differences and how it may be that valued, and even like maybe even interest rates. Sometimes interest rates may have very little impact on the stock's valuation. And sometimes it could have more, but it's also stock specific, and you'd have to create that customized model. Like for example, like maybe a biotech stock that is valued on on its research on breakthrough, maybe medicine, maybe the interest rates there have very little impact on the valuation. Half a point interest rate cut will barely make any impact because it's valued differently. But maybe something like a REIT or a preferred stock, those might be much more sensitive to an interest rate move because they're based on some kind of cash flow model and return on your like dividends or whatever. So as far as like an across the board scan like that, we wouldn't have it because it does require you to customize a model, a financial model based on the specific asset you're looking at. Um, even like I think like Netflix at one point it wasn't even it was like the growth rate of subscriptions, for example, was that's how people were basing how the speed of new subscriptions and so forth. Uh, at one point, that was the model people were looking at. But when we look at options, and you could see here that we have here's an SPY. We have all these different expirations, right? And if I click on an expiration, we have all these different strikes, and then we got calls, we got puts. So when you have so many different options, right, how do you value them? How do you look at their sensitivity and so forth? That would be hard to customize a model for each one, especially that they're changing all some of they'll expire, they have different expirations, they have different strikes to model, customize for each one would be very, very difficult endeavor. So that option pricing model really helps because we could use it and give it certain inputs. And based on those inputs, we could get like an estimated value. That's like the theoretical value, let's say we call it, where, well, what do we think this option is worth? And one of the components is interest rates, right? So interest rates play a role in what an option would be worth. And that component in general, what will happen is that if interest rates, let's say, go down, right? Let's say that the interest rates go down. Well, what impact would it have on the option price, right? Like, what impact would it have on a longer term or shorter term? Um, so, so when you lower interest rates, okay, when you lower interest rates, that will have an impact that it will tend to lower the price value of the call, right, and increase the value of the put. So the reason behind that is when you think about it, if you hedge a call, right? So let's say if you're buying a call, right? So you buy a call, you get long delta, you hedge it by selling short stock, right? So now you're delta neutral. Let's think of it from that point of view. So I'm delta neutral. I bought a call and I sold stock. Well, if you do that and you sold short stock, what will happen is that you borrowed a stock that you didn't own, you sold it, and then you received the cash in your account, right? Because when you sell a stock, you 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 gave the stock to somebody in return for cash. Well, that cash now earns interest in your account, you know, based on whatever deal you have with the broker. You know, maybe some brokers don't pay, but some brokers will pay, or like you take the cash and buy a treasury with it, and then you get interest. So, so the more interest you earn, the more valuable that call will be. The less interest you earn, the less valuable that call will be. So, as from an options perspective, right, what will happen is that interest rate will impact the option prices across the board because all calls, right, will become less valuable based on that risk-free rate. Okay, the puts will become more valuable, right? Because it's the opposite, right? When you buy a put, well, how do you hedge a put? Well, when you buy a put, you're short. You're short deltas, meaning you're looking at the stock, you want it to go down. But to hedge it, if you're short deltas, you would need to buy stock, right? So you need to go out and buy the underlying stock that's equivalent to your deltas to be neutral. That means you're trading the Black-Scholes model where you're delta neutral and you're trading the implied volatility versus the realized volatility. Well, if you're buying stock, right? If you're buying stock, well, what does that mean? Well, either you have to you have to come up with the cash, right? Somewhere you have to come up with the cash because it's not free. So if you're buying stock, that means you have to take either cash that you have at the bank, right? That's earning interest. Take that out so you stop earning interest and you buy stock, or you have to borrow money, right? And borrow money to buy it. Buy it on leverage, on margins. Well, in both cases, you're either foregoing, the opportunity cost of earning interest, or you're borrowing money and then you have to pay interest. So the lower the interest, right, the less interest you earn or the less interest you have to pay, well, the more you're willing to then pay for the put because now your cost of carry is low. If it goes up, then the less you're willing to pay for the put. So from the perspective of interest rates and option values, interest rates going down will tend to increase the value of call options, decrease the value of the puts. However, they're all different sensitivities. right? And we call that the row risk. We call it row risk. Let me see if I could come up with an option that we could test out. Let's go like to March. So you got 125 days. Let me just pick one out here. I'm going to run this analysis. So I just put up a call. The March 21, 2025 call, the 585 strike, which is, already above where the spot is for 1949. It's $19.49. That's the offer. We're going to run this analysis. So we get all this, all this analysis here, but what we're interested, I'm going to close this side menu to expand our screen. Where we're interested is in the interest rates. So I'm going to come over here in the summary, and let's look at the pricing and risk sensitivity. I think we created an interest rate component. So here we have an interest rate component of 4.43%. So this is an assumption, right? What is 4.43%? We don't know what the average interest rate is definitely going to be between now and March 21. March 21, there's 182 calendar days here of interest rates. So it's not, known for sure that between now and that expiration, what the interest rate will be, because tomorrow, who knows, something could happen and the Fed will say we are dropping interest rates to zero, right? Whatever. It could be some kind of a big event or whatever, just like we had with the COVID or something. So we don't know for sure what the interest rates will be between now and then on average. They could fluctuate, or they could go the other way. They could go up because all of a sudden there's like an, inflation risk, something has to do, with, imbalances somewhere or currencies or whatever it is. They might have to take it up. So you could see that this is an assumption within the option pricing model. So how do we come up with it? Well, we can look at the term structure that is available to us right now, because we could look at the treasuries, right? We could look at the treasuries, the short term. We could look at the 1 month. We could look at the 2 months, 3 months, 1 year. We could look at those treasuries and see where the markets are pricing these interest rates right now. So this is what this is doing for us. Right now it's looking at the treasuries and interpolating based on the averages between all these dates, like what approximately is the interest rates that the market itself is pricing in. And these fluctuate. So these will move around based on new data as it comes in. So we have this 4.43%. And based on that, these are assumptions. Let's say the market right now is the option is $19.49. But what if we took it down? What if we thought the average interest rate is going to be 3%? Like, it's just too high. We think that the Fed's going to move faster. Let's say we think the Fed's going to move, down a point, whatever it is. So on average, between now and then, it's going to be 3%. Well, what would this option be worth if that's the case, right? Because the 4.3%, that's the assumption that's the average interest rate between now and expiration. But what if that assumption is wrong? If that assumption is wrong, that means that the value of this option is wrong, right? If everything else stays the same, implied volatility and so forth. So let's give it 3% and see what happens, right? Let's change this by 1.4% and see what the sensitivity is of this option. Maybe it's too high, because if that's our assumption, we're like, well, the market's got it wrong. I think the Fed's going to move faster. These interest rates are way too high. So let's put in 3%. Okay. I'm going to run this analysis. So this is what it looks like now. The stock moves today. I'm going to put 3%. We'll run that analysis. So you could see here at 3%, that's now comparing. So this is comparing to right now, the option's worth $19.49. So if we went to 3%, this option's worth $19.41. So 8 cents lower. Not a huge deal for this option, right? It's not that of a, 8 cents. It would be basically overpriced today. Let's go back. So that's if we lowered interest rates to 1.43%. What if we went to 1%? Let's try that. So 1%, also not that much. So it doesn't have a big row. What it would do is you would lose $390 right now in interest for that one option. Okay. So that's kind of like where you could start looking at interest rate sensitivities. And here, what's interesting, so as you go, so look how this graph looks, just another observation. As the stock price goes up, right? So look, if it goes from current price 567, as it's going up, you could see that the difference, the spread between 4.43% and the 1% is widening out. It's worth less and less as the stock goes up. The reason for that is as the stock is going up, well, you're getting longer deltas. You have to sell more stock to hedge it, right? So you're selling more and more deltas, right? Because if the stock's all the way in the money, 1%, then to hedge it, you're selling stock based on 100 deltas, 1 for 1. The more out of the money it is, the less stock you're selling. So the more stock you're selling, the more money's coming in, the more interest you would earn. So the sensitivity of the option to interest rate also changes as we're moving to different strike prices. As the stock moves higher, you could see that the sensitivity of the option increases to the interest rate, right? Because it's more and more in the money. All right, so Will, I think I'm going to stop there.
All right, that was super helpful, D. We did have an outstanding question we'll try to get to tomorrow concerning zero DTEs. Awesome job, my friend. Thanks for the question, Rob, as always. You have a great day.
Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day.